Hi, Nifty 50 at 35,000 by December 2027. सुन के लगता है 45% upside. Seriously, by the end of this conversation, this will not be a prediction, but it will be a conviction that we can ride the tide. We have with us Mr. Vivek Doval and Mr. Amit Sharma, who have been investing globally for more than 2 decades, and now they are building a portfolio in India. So I wanted to ask them, why India and why now? Why is it an apt time now? Welcome, Vivek. Welcome, Amit.
Thank you very much for having us over, Anuj.
Vivek, let me start with addressing the elephant in the room. Foreign investors have been exiting to the tune of 2.5 lakh crores in this year. So what will get them back? I mean, we need to build our conviction if we need to believe in the 35,000 Nifty in 18 months. So what do you think is going to get them back, Vivek?
As Anuj, we have been saying this at many times that the value is emerging in the Indian market in way of simple metrics like the price to earnings is trading at about 15 times earnings, forward earnings. Now, this is at a historical low. That is, the market has been cheap for a while and has actually got successively cheaper as time has gone along and the earnings have come. We've just ended first quarter 27. We are seeing this growth re-accelerate. So the growth coming back into the Indian earnings, the earnings growth of the Indian corporates is the principal driver why we are exceedingly positive on the Indian markets going forward. We think that it is high quality growth, it is durable growth, it is the kind of growth that foreign investors have expected of India in yesteryears. But that had been lean over the last 1 year or so, but it is visibly coming back again.
We already see that around 20,000 crores has come within this month. So these are the points that you feel is triggering them to come back and will re-rate the market from 24 to 1,000 to 35.
So to put it in equivalence term, that if you had a flat in Gurgaon or in Bangalore, the price of the flat was already 30% lower than what it used to historically be. And now the rental growth is also coming through in the property. Now, what is so bad to like of a property in which the rental growth is coming back and the value of the property is 30% lower than what it used to be? I think all the investors, domestic and foreigners, are noticing this. And actually, how can they not? It is so attractive.
And just on that point, Anuj, FIIs are not just looking at just the growth factor. They are looking at India as a combination within the overall scheme of the world. And there are other things they've been looking at as well. And we'll discuss some of those points. Things like AI, things like other markets rallying and India not rallying as much because of AI. We will talk about that briefly. So there's been that. There is an allocation of capital issue. There is an issue whether they should allocate more to developed markets or less to India, less to developing markets. So it's got nothing to do with India. It could be just that. So there are many other factors also there. And
Right.
Some of those I will, come back in during this conversation that some of those are also turning.
Right. And Amit, I must point out that, of course, you're joining from London and your video is a little foggy. And my video here is much better and less foggy. And that is what we are here to achieve. India is becoming less foggy. So on the lighter side. So Amit, help us through the uncertainties to make it a little less foggy. So the uncertainties of the monsoon deficit that we are already facing, and the uncertainty of the US-Iran war and the impact of that in India. Before we move on to the drivers, let's address the uncertainties.
India's been going through these various uncertainties. Vivek mentioned the tariff war was one. And ever since September, October, there's been just uncertainties after one after the other. One gets resolved, the other comes in. So you had that. Then you had the Iran war. The moment it starts resolving, Iran war and the oil price, hit that we saw, increase that we saw, and that has definitely been an issue for India. Then on top of it, we have this El Nino effect, which is playing out in the world right now. which is impacting. You can see drought conditions in many parts, including in the UK, where there isn't been that much rainfall. And in India, as you just mentioned, I think as of yesterday when we were tracking this number is running close to about 12% deficit, which is not bad. It is a deficit, but it's not bad. And why do I say it's not bad is because companies are telling us, the companies which are selling things in the rural, the FMCG companies, the two-wheeler companies, the tractor companies, they are seeing stable to reasonably stable demand given this backdrop. First of all, monsoon period is not yet over, so there is that phase where we are still seeing a lot of catching up that can still play out. So amongst the uncertainties, there is always a lot of them, right? So there are a lot of uncertainties, but one after the other, what you see is things aren't that bad. You have to see past it. And you have to always remember, market is always looking 6 months ahead. So they've already seen what has been seen. They are looking past it. Is it going to be bad? Is it going to be very bad? Or is it going to be just okay? If it's just okay and market is pricing in a very bad scenario, we will see a pickup. So I think at the moment, the worst thing that is the issue which has been impacting India, the market, and the rupee has been the West Asia war. We think that issue will be resolved as we speak. Maybe even today, Friday the 7th, we may see a resolution on it, or in the next couple of days. Once that happens, one big issue goes away. Monsoon running at 12% deficit, I do not think that's so much of an issue. It has caught up. And yeah, there may be some other uncertainty which will come in 6 months' time. But, so far, everything is looking good.
Maximum profit is made where maximum uncertainties are there, provided we can see through the uncertainties. And that is what Vivek and Amit were helping us do here. We've looked at FII and we think they've already started coming back. The monsoon is 12% and the crude prices are around 80 now. So now coming to the drivers, Vivek, you did mention the first quarter earnings of FY 2027 have seen a pickup. But what my question to you is, we are not seeing the similar pickup in the markets. The earnings are picking up to 11%, beating our expectations, but the markets are quite flat.
We have been in the midst of a variety of uncertainties. First is with regards to the war. That how long will this war last? What impact will it have on the supply of crude? So these uncertainties have actually had an impact on the market, an overhang. We have to make some very, very big building blocks here to actually understand where we are. As I said, the starting point is we are trading at a depressed valuation. We are trading at 15 times earnings. It is more likely to go up than down. So our valuations are extremely attractive. That is, even if there wasn't a very good catalyst to re-rate the market up, it would be a worthy time to buy the market just because of it is just being cheap enough. The second building block is that it is very notable that as the war has actually carried on, the price of crude has actually come down from its peak of $120 to $80. So even in the wake of the uncertainty of the war, the supply of crude from a variety of countries, such as the United States of America, from Russia, and through the pipelines in the GCC countries has only gone up. And the small ceasefire that we got, we saw maximum crude flowing out of the Gulf into it. So actually, currently in the oil markets, we do not have a deficiency of oil. We actually have a slight glut. So the oil situation is not as bad. Third is the financialization of the economy of India. That ensures that even when the monsoons are weaker, there are stabilizing mechanisms in play where, where the monsoons are weaker, of transfers that happen from the government to the people, to the most vulnerable people in the rural, prone areas. For example, in this year, the rainfalls are particularly weak in Bihar. So the chances are that the people who are most exposed to the weaker monsoons would actually get, more benefits and transfers. This was not the situation when we had the monsoon deficits of 2014, 2015, because the financial infrastructure wasn't in place. In addition to that, we actually have a situation in the economy currently where credit growth is behaving really well. that the credit growth is probably running at about 17% in the first quarter. That means money is actually moving through the economic system.
एक मजेदार बात है, बट हमारा इंडियन रिटेल इन्वेस्टर जो है उसमें कन्विक्शन और कॉन्फिडेंस एक अलग लेवल का है, एंड आई एम रेफरिंग टू द SIP inflows. So Amit, the SIP inflows have been positive over 63 consecutive months to reach 31,000, rather crossed 31,000 in June. The Nifty went down, but the SIPs continue to grow. One, what do we read about that? Second, what are the cautions that you would like to tell the retail investor, SIP investor?
I think first thing is, बहुत देर से I've been tracking this number, and I was tracking this number during the war, around the war, when the rupee was falling and everything. I was saying, up to maybe there is a panic coming. Maybe there is a panic coming. As you said, this number has been steady, very steady. And we've seen this in past downturns as well over the past 1 to 2 years. जब भी थोड़ा सा downturn आता है, this number doesn't move. And is that a good sign? I would say definitely, because it's been, it's a very good dollar averaging strategy, which people follow, which over a period of a long 5 years, 7 years, you always end up making money. I mean, that's the past track record. So it's probably, in my view, a sign of financial, education of the people and the level that it is going. So it's a very good sign. That's one. Second is, you should also look at it in the context of the overall allocation an Indian household has to equities. That number is still, after all these SIPs, it is still in the low single digit number. That number is like 5% or 7% of the overall assets into equities. So I see this as a much more structural trend and it has been shown that way. And this number has been creeping up. Every month, that number is actually moving up, not coming off or stabilizing. So good sign. Sign of caution, I think, not at this time. I mean, it's a very good market to actually invest money right now. And, the reasons that we are discussing here, valuations are the cheapest, cyclical recovery is happening, and long term, just putting this number in perspective, and Anuj, I'll talk in dollar terms, but you're talking about $3 billion every month of SIP flows coming in.
That's right.
Annualize that, multiply by 12, that's $36 billion, right? The size of FII outflow we saw last year, or this 6 months, is to the tune of $20 billion. So this number is more than offsetting this other FII flow, which most people don't realize, but it's a very important factor. 10 years ago, that wasn't the case.
Right. And this comes back to the पहले जो विवेक ने आंसर किया था कि FIIs भी वापस आएंगे तो कैसा री-रेट होगा. That is what
exactly. And this is exactly, Anuj, what you have actually seen in the last month or so, in the month of July, that you have seen that the Nifty has rallied in the month of July from being down 8-9% at its lows to now being down about 4% on its lows from the start of the year. The rally that you have seen in the market is a function of the cushion that this market actually gets, of course, from the systematic investment plans and from foreign investors returning back into the market. So whilst we have been very positive on the Indian market for the last 1.5 years, it looks like the foreign investors have just woken up recently.
Right. I also connect this to what you guys were saying about the allocation of savings. Now, that is where I think the culture of India comes in. We are always, India has a culture of saving, which is not as much in the West. They have negative savings, actually. One, there is a culture of saving. Second, within that culture, the allocation to fixed deposit has come down by around 5% over 5 years. And that allocation that is come out of fixed deposit, some of it is now going into the equity market. So we have seen within that culture of saving, we are seeing that trend of taking a little risk and moving from fixed deposit to mutual fund to equity and through SIPs and all that.
Anuj, if you wanted to go a little deeper into it, not only is the allocation of savings actually moving away from fixed deposits and gold into equities, I think just as big a story is that the total saving pool is growing at a very big rate. So if the economy is growing at, say, a GDP growth rate of 7%, and you have inflation of about 4 to 5% on top of it, so 12% per year of nominal GDP growth that you have. If your savings growth is growing in line with that means in every 6 years your savings pool in the economy is doubling. That is, the total amount that the economy is saving is almost doubling every 6 years on these kind of metrics. And so the total saving pool is doubling. That is the accumulated savings of all the people in the economy, the private sector and the government sector, every 6 years in a fast growing economy of India, 7% is doubling. And the allocation in this savings is also moving away from fixed income and gold to equities. So this number that Amit defined, about 36 billion, don't be surprised if this number would be running 70 to 100 billion in about 10 years time. On an annual basis.
Very interesting. So, Vivek, love the way you put the data together to say it's not just about the allocation. Of course, allocation is there, but you also said that the pie of saving is growing at a 12% rate. GDP plus inflation and the salaries growing leads to that pie growth. And that gives us clarity why the SIP is growing at that rate and sustaining that growth. So now coming to the centerpiece, the journey from 24,000 to 35,000. Vivek, I've picked this graph that you can see on the screen. I have picked it from the Torch Investment Lab thesis that explains the case from 24,000 to 35,000. And it relates how the PE growth will reflect in the Nifty growth. If you could explain us this graph, Vivek, it will be very helpful.
Yes. Anuj, as you actually look at the bottom end of the graph, you can actually see the Nifty around 24,000 levels is trading at 15 times fiscal 27, that is calendar 26 earnings. So this is where we are at the moment. It's trading at 15 times earnings. Now, if you look at the historical valuation where the Nifty has traded, it has traded at about 22 times earnings. So as we actually go from this year to next year and from the current fiscal 27 to fiscal 28, which fiscal 28 is essentially mostly around calendar 27. So as we move from 2026 to 2027, we actually see a bump up in earnings. So the earnings actually go up in the magnitude of about 12 to 13%. And at the same time, the multiple of the market also, if it normalizes from its current multiple to what it has historically been, from 15 times to 22 times, you see a bump up in the value of the market, the potential value of the market, to about 34,800 odd. That is 45% higher from current levels. So another way of putting it is that you get about 14 to 15% increase in the value of the market on account of the new earnings growth or the higher earnings growth coming in 2027. But at the same time, you get 30% increase in value of the market because it goes back to a more normalized market valuation as opposed to a depressed valuation where it is. Combine the 30% plus the 15%, you get to 45%.
Right. Vivek, that was very interesting. But very honestly, I want to ride the tide. Our viewers want to ride the tide. We want to build the conviction. So Vivek and Amit, both of you have explained us the math, the uncertainties and the drivers, the corporate earnings and the SIP inflow. Help us build more conviction so that we can ride the tide. So Amit, over to you. The India AI narrative is going in two layers. ये दो layers में चल रहा है. One is the infrastructure layer and the second is the Indian IT pivot. We can see some traction. So Amit, can you help us look through the India IT narrative?
I think one of the factors, you point out AI has been treated negatively for Indian market so far. And I'll tell you why. Partly from the fact that one of the large sectors in India, IT services, there's a lot of narrative which is talking about, IT sector services is basically labor arbitrage, and it was a billing per hour business. Now with AI, you don't require that many people. hence this business will suffer. I'm putting it very simply, but that's one of the narratives which has been affecting the IT sector services stock for the past 1 year. Actually, these stocks have derated, both in terms of price. The price action has been weak, but also in terms of multiple. These stocks used to trade at 25, 30 times multiples. Now they are trading at 14, 13, 12 times multiples. So there's been a big derating here, and that is impacting things. This is the view of the market. We think differently.
Vivek, kindly give us clarity on the India IT narrative.
Of late, in the last 2 quarters, we have actually started seeing that for companies like Tata Consultancy Services, TCS, and Infosys, the AI revenues have started recovering. So, if you actually look at the total revenue growth of the Indian IT services, it is typically starting to recover. But underneath the surface, when you open the hood, the AI revenues are actually growing really, really rapidly. Now, we think this will be more visible in a few quarters' time. These businesses are here to stay. We believe that AI adoption at the enterprise level will require, domain experts of the various sectors and companies. Indian companies and sectors understand the businesses of their clients, and the clients are seeking more AI-based solutions. But embracing AI into the enterprises is far more complicated than doing it for consumers like us. And we do believe that Indian IT services companies are well positioned for that ever growing opportunity. So we do think that there is a considerable chance of a recovery happening for the Indian IT services companies. And second was a factor with regards to HDFC Bank merger with HDFC, and that affected because as HDFC moved from being an NBFC to become part of the bank, that had an impact on the loan to deposit ratio for the HDFC Bank. It was a little higher. And so they needed to consolidate their book in order to make sure their LDR ratio, their loan to deposit ratio, was more in line with the regulatory norms. So these two factors, the HDFC situation, which has now been corrected completely. Now the LDR ratios of HDFC Bank are totally in line with regulatory requirements. And secondly, the sell-off in IT services on account of the weakening slowdown, which was also partly artificial intelligence related, and partly also because of perception that how artificial intelligence affects the revenue outlook. Both affected the IT services companies. That is just level 2. Or rather, of this whole AI journey. The first, why I say it's level 2, in the first level, it is the hardware companies in artificial intelligence who are gaining, the chipset manufacturers and the data center. Level 2 is probably where the services companies actually start benefiting. But I think the bigger opportunity actually comes beyond that, to all the companies within India, particularly the larger companies which have got large volumes of data. When they embrace artificial intelligence in their operations, they will be able to embrace, massive productivity. They'll have considerable productivity benefits coming through for them, which will create positive opportunities for them on their top line and cost reduction as well. So, artificial intelligence pervades beyond just services, but it will go deeper into Indian industry. And that is another reason. And that is something that is a little hard for us to be able to understand precisely. But it is something that will have a global impact. Not just in India, in US, Europe, everywhere in the world, but also in India. And that should also be a reason to be positive on Indian economy.
Right. So artificial intelligence has been a drag for the Nifty, but as Vivek said, it is already becoming a driver because under the hood, as he said, the revenue contribution of AI to the likes of TCS, HCL has been substantial, and we have seen 60% revenue contribution to growth in HCL from AI, which is what Vivek has exactly pointed out. So Vivek, you touched upon HDFC. So the dot that you connected was that TCS and HDFC have high weightages in the Nifty 50 and have been dragging. But you did say that the sleeping giant will stop dragging and may become a driver. First of all, why was it a dragger for the Nifty over the past 2-3 years after the merger, as you said? And then why do you think is going to be a driver, the LDR that you were mentioning?
Well, absolutely. Let's just first of all remember, HDFC is probably one of the most successful organizations in India in the financial sector, which has enabled millions of people to actually build home ownership. And, the bank that the HDFC created subsequently, which was HDFC Bank, ended up becoming a leading private sector bank in the country. So we are talking about two high quality institutions that existed in the Indian market. Now, at a certain time in the last few years, it was decided that HDFC and HDFC Bank, which came out of HDFC, should merge up again. The merger did happen about 3 years back. And as that merger happened, it was the case of the HDFC Bank, which was a bank, acquiring HDFC, which was a NBFC. Typically, the loan to deposit ratio that an NBFC does are higher. So the LDR ratios for NBFCs can be higher compared to a bank. So when the HDFC merged into HDFC Bank, and it was running an LDR ratio which was higher than 100%, and HDFC Bank, which was lower within the regulatory, overall the LDR ratio of the combined entity was running way over the regulatory hurdle of 100%. Now, in order to actually get the LDR ratio in line with the regulatory norms, they had to do two things. One is to expand their deposit base, and the second is to reduce their loan growth. They did both of that, but the deposit growth only happens over time, and loan growth is something that they could do very quickly. So when they did it very quickly and they reduced their loan growth very quickly in the economy, people interpreted as the bank is underperforming. No, it was not underperforming. It was just consolidating itself. And as 2 to 3 years have passed, the deposit growth has now got up, is much bigger than before, and the loan growth has come down, and now we have a situation that the actual LDR ratio is within that 80% level, odd, where it ought to be. I think it's probably a little higher than that. But now what this basically means is that their balance sheet is in a position to lend out as fast as the other banks. One of the things that affected them, because they had to raise deposits quickly, was they raised higher cost deposits from the market, right? Which over the next 1.5 years, they will be replacing it with lower cost deposits, such as CASA ratios, such as current account, saving account deposits. So they have been taking more deposits in the wholesale market and fixed deposits, etc. As the mix changes, their cost of funding will also go down. The cost of funding will go down, their yields will go up, and their loan growth will pick up. So you will have a trinity of positive impacts coming through for HDFC, and that should boost their earnings. There has been also a change in chairmanship. So there is greater corporate governance certainty as well, which is also a positive.
So you think HDFC will also be driving the Nifty?
Yes, I think as of this year itself, as of fiscal 27, HDFC becomes from being a drag to the market to a positive contributor.
Right. So over to you, Amit. One of the points in your Torch Investment Lab research paper is mentioning about the MSCI weightage. The MSCI weightage for emerging market index has gone down for India from 2024. Kindly, if you could explain what is MSCI index and why should the Indian investor care for it?
Some of these factors are, Anuj, we call them as technical factors. Technical factors means these are not the usual factors that impact the market, and they usually don't have a lasting impact beyond a certain phase. because they don't drive where markets end up. They are just followers. And I will explain that in a little bit. So MSCI, as you know, there are different indices in the world. Like, in India, you have Nifty. There is NSE 500, NSE 100. Then you've got Sensex. And certain indices are used by various index providers to create passive funds like ETFs and all. So what happens is whatever is in the index is replicated by the ETF provider, and then people can buy the index. So instead of buying one stock, they are buying Nifty 50 stocks using that ETF. MSCI is a very large index provider globally. It's got lots of different indices. One of the indices is MSCI Emerging Market Index, which is what you're talking about, where India falls into. Now, this index, I think, is tracked by about $1.5 to $2 trillion worth of capital. So it's a large, sizable. When I say tracked by, it is used as a benchmark, or it is, people just follow it blindly. So very much depends on what the index provider puts into the index. And it is usually a rules-based kind of allocation. So what has happened, you mentioned, so very specifically in 2024, what happened is, so this index contains countries, so MSCI emerging markets includes India, China, Taiwan, Korea, LATAM, Turkey, and many other countries. And this index is a market cap weighted index. Okay. So, which means if one of the market is rallying a lot more than others, its weight in the index goes up.
Okay.
And this is very important because what happened since 2024 is that Korean market, because of a couple of stocks and AI, has gone up 100% plus over this period. Taiwan market has gone up because of one or two stocks, gone up by 70% during this period. Indian market in dollar terms during the same period is probably down 15%. So mathematically, the weight of India came down. Now, is that a cause of Indian market falling? No, it's just a symptom. It's an after the fact thing, but it helps. So that's what's played out. If you were asking me the question, that's right. What has played out. But I think it is a symptom rather than a cause.
So Amit, as I understand, this will have a cascading effect in the growth as well. So as the index will grow from, Nifty index will grow from 24,000 to 26,000, the weightage of India in the MSCI index will increase. That will get more dollars coming in and will have an exponential effect. Is that
there's
what
an assumption
saying?
In there? You're right, partly right, but there's an assumption in there. The assumption is the other markets don't go up. Right. So I don't know that.
Let us actually, I'll give a little, a brief on that so that it will make a little easier. That in the current context, that is in the month of July and August so far, you've seen the Korean markets correcting by 30-40%. So automatically their weightage in the emerging markets has come down. And the weightage of India has gone up. So ceteris paribus, that is keeping everything else constant, more passive money should flow into India because India's contribution now is bigger.
Right.
Versus how, the passive money is currently positioned. So India's weightage in the MSCI is higher relative to how much people have invested. And so more passive money should also cause the re-rating for the Indian market.
Now, the same reason what brought the market down in terms of passive flows is going to reverse and exponentially have a cascading effect. Completely understand that. So, Vivek, the credit growth in India has seen an increase by over 18% in June. What do we read out of that, Vivek, if you could help us through?
So, Anuj, we have seen the credit growth actually doubling within 2 quarters, from about 8 to 9% to 17% in the first quarter 2027. And credit growth is happening at a time, not from any one particular sector. It's very broad-based. You are seeing a credit growth pickup that is happening within the corporate segment. You are seeing it within retail segment. I think the big drivers of credit growth that are happening in the economy, actually, before we go into the drivers of the economy, this scale of credit growth in the Indian economy is extremely strong in the context that the Indian inflation is only running at closer to 5%. So if your credit growth is growing at somewhere around 17% and your inflation in the economy is running at 5%, that means your real credit growth in the economy is growing at 12%. This is very different from a number that we would have had maybe about 14, 15 years back, in which the credit growth in the economy might be running at 16%, but the inflation was running at 11%. Right. That meant that the real credit growth in the economy was only 4, 5%. Now you actually have a situation in which you have about close to 12% credit growth. What that implication is that the economy is accelerating, that the GDP growth is accelerating. These are metrics that we start looking at to get a better handle of how the economy is doing. And it looks to us that the domestic economy is accelerating. And now, what are the drivers of it? I think one of the big drivers of it have been the large government-led infrastructure projects. We've also seen a tremendous amount of private capex getting expended in the economy. Now, partly that is also related to governmental programs such as semiconductor sectors and the likes of that, etc. Just like the public sector is opening the roads, the private sector is setting the factories on the side of the roads. Right. So the credit growth is a big number. Its real credit growth is even stronger. It is very varied. It is across sectors.
Right. Now that I am speaking to the people who have written that thesis, I understand that the reasons that we are talking, that the drivers are actually having a cascading effect to reach the 35,000 mark and maybe beyond actually. So आज हमने uncertainties के बारे में बात की और drivers के बारे में बात की. Uncertainties पे we discussed about the monsoon, which is already at 12% deficit, and it's raining cats and dogs, at least in the north presently. So we have a month to catch up. So that uncertainty we could see. The FII selling, the MSCI weightage are now becoming drivers. Were the drags, but becoming drivers. Same, I think, जो आप लोगों ने बताया, we can say about the IT sector and HDFC balance sheet that has got repaired. So the reasons what dragged the market will now stimulate the market to 35,000, and that is what the torch thesis is. Thank you, Vivek. Thank you, Amit, for taking out time to build our conviction so that we can also ride the tide. Thank you so much for being a part of this discussion and giving us your insights.
Thank you very much, Anuj. As we say that follow the earnings, as will the earnings, so will the market. So thank you very much.
Thanks a lot,
Perfect
Amit.
live example. Thanks a lot.